On today's episode of the AI Investor Podcast from 24/7 Wall Street, we dive into the sell-off hitting AI stocks and identify which companies in the portfolio look the most promising right now. All of that and more is next. Welcome back to the show. I am David Hanson, joined by Eric Bleeker. Eric, coming to us from Argentina. Thank you for taking the time.
Yeah, I just finished up a red eye. The market's been crashing all week. Ready to go, David. What can I say?
Red market, red eyes. What can you do? So if our sound sounds a little bit different this episode, we've got thousands and thousands of miles between us, but hopefully we're good to go. Eric, it's been an interesting couple weeks since our last show. I'm excited to talk to you about it. On one hand, we've got some encouraging, exciting announcements about the future of AI, kind of at the consumer level from companies like Meta came out saying, hey, we're going to be building a standalone app. OpenAI is coming out with new models. So on one hand, you could be like, oh, there's still positive developments, new things coming. Seems like every week the companies building the models are saying, this is our best model yet. It's getting better. It's getting better. But, we're an investing show, and I'm sure any of our listeners have been watching the stocks. It's been a different story when you look at the actual stock market, and it's been a rough couple weeks. On a previous show, we remarked how Meta, I think, had gone up 19 straight days in a row. And then I think it went down 7 straight days. So there's been a lot going on. There's a little bit of uncertainty now, maybe a little bit of fear from our listeners or people who've been following along with our narrative. So I wanted to start with, there's a lot of factors driving the market, but what is your take on this kind of sudden uptick in fear and a little uncertainty going on in this corner of the market?
Yeah, the first thing I would say is just, if you are holding any of these stocks, it's painful. We recognize that. I did this portfolio because these are stocks I personally own. As I've mentioned on many podcasts, this isn't my entire portfolio. My entire portfolio right now is down a couple percent year to date, but our AI stocks have retrenched dramatically since DeepSeek. And when you had cursed us by saying we're at the cool kids table, I think that was the end of all this. I think someone needs a Hanson voodoo doll for this one. But when you had said that, we were talking about how there's 19 out of 20 stocks that were up at once. I said, well, that doesn't necessarily surprise me, just because in the near term, all of these stocks are being driven by kind of the same narrative. So you're probably going to see a group of either up or down. And we're seeing that work in both directions now. We get listener questions. They were a lot nicer before previous weeks, and now some are a little more mean. That's all right. But, partially it's just, you have to keep everything in context. And the higher a stock has risen recently, the more it's going to fall when you have a risk sell-off, which is very much the broad market environment. So, David, I think we have 2 key issues that we'll focus on individually. Number one, I would say, is just a broader overarching market situation about what type of assets are being sold off right now. That's being driven largely by uncertainty kind of on the political front, and we could talk about that. And second, you have some narratives in the AI space itself. We first had DeepSeek, but more recently we've had some chatter about Microsoft. And I will promise I have a little rant on this earlier. So if anyone wants to hear me a little angry, we'll have that coming. But maybe, David, we could I think it's worth looking at the broader market first right now.
Sure. Let's jump into the broader market. I mean, we've had, coming into 2025, I think on our first show of the year, or maybe it was our preview show, we talked about the great performance in the market in 2023 and 2024, and how there's not a lot of historical precedent for what does that next year look like after such a great run. And we talked about, sometimes I think it was in the 90s, maybe there was a continuation of a great bull market and things kind of went straight up, but oftentimes you hit some chop and things get a little bit tougher. So we still do have a market that's retrenched overall a little bit. It's still trading at maybe what would be historically expensive multiples. I think the S&P is still near 30 times from a PE perspective. The NASDAQ is maybe in the mid 30s. So still a little bit of expensive overall market. Is that kind of what you're thinking about when you think about that market overall? Is it just this is a valuation story rather than growth slowing, and that's a big concern?
Well, I think specifically to your point, when you have valuations of the S&P 500 in the upper 20s, there's a lot of growth expectations built in. And when you have uncertainty, we're not a political show. I don't care if anyone voted for Trump or Biden or whoever. We will only analyze things as they pertain to the financial markets. And the reality is, the recent actions from the Trump administration are creating significant uncertainty. You have tariffs, you have a lot of areas related to maybe economic slowdowns and, some of the actions around cutting jobs. And you also have the potential prioritization of the treasury market. If you'd like to look at this negatively, one tweet I said was, if you're trying to get down the 10-year yield by kind of bringing down the economy, that's like trying to cook a steak by burning down your house. Like I said, that's a little more uncharitable. But if you are focusing on, by any means necessary, getting 10-year yields down, and that might come at the cost of the economy itself, that's going to be a negative for stocks, because one of the big stories this year was S&P valuations in the high 20s were largely predicated on the strongest earnings growth in years happening this year. So often what happens when you hit these situations where the broad kind of trend within a macro perspective is selling, it's just, you watch it. You can see almost every single day a divergence between a Dow Jones that's going to have companies like 3M leading the way and the NASDAQ. And you're just going to see stocks in the NASDAQ see often 2, 3, even 4x kind of the losses that we've seen recently. Mm-hmm. So I think it is just an environment when you have a risk-off situation. We had some of the AI kind of centric storylines like DeepSeek that added the perception of more risk for many investors. And then you have kind of the geopolitical situation that's leading to, you see it in Meg 7 type stocks that are getting sold off, and it's going to be even more exaggerated for small cap stocks that are kind of very levered to this trade. So I think from a geopolitical perspective, that's what we're looking at right now. Now, I would caution some perspective for investors. If maybe you're listening to this podcast, you don't have as much experience investing through past market trends and cycles, what feels extremely painful and sometimes unprecedented today, there is a precedent far more recent than we even remember. And one of the reasons that we had launched this podcast was last August, there was an extreme kind of opportunity with a risk-off environment, largely related to expectations around interest rates. And we had been talking about doing a podcast on AI. I said, we're actually in a great opportunity zone to get this started. And this is a great place for people to be able to pick up shares. So as hard as this might feel in the moment, these are the areas where, again, these are the best times often to get started investing, is when bearish sentiment is the highest, which, David, I believe there was I forget the company that does it. It's AAII. They do a bull bear indicator. Right. Yeah. Yeah. And it came out last night. I just saw it as I was getting on the plane for my journey, and it was the lowest almost since 2009. And generally, when readings are that low, it is contrarily a positive indicator. So I think as you noted, when you look at the valuation multiples, this is something that could go deeper, depending on a lot of these factors, like how uncertainty at around tariffs and many of these other geopolitical areas, and how interest rate expectations are working. But all the same, if you have the stomach for this and you are ready to have some of your best ideas ready, this is often the best time to put new capital to work.
Yeah, and I know you want to get into, we're going to get into some of the names in the portfolio and maybe do some risk rankings to understand, where's the best risk reward right now. But I just want to point out too, we talked about market multiples, and obviously we've been targeting companies that we think have really great growth potential. We talked a lot about hitting that inflection point where, suddenly the business just takes a step up in terms of demand from their customers. When you look at the valuations within the portfolio, given that we're going for more aggressive growing companies, the valuations often look pretty reasonable on some of these. I would, I haven't done the exact math, but I would guess on kind of a weighted average, we're right at, or maybe even below kind of that NASDAQ multiple within the portfolio. I would bet our weighted kind of PE ratio of the next 12-month PE is probably in the high 20s as well. So it's not like this portfolio is taking on extra risk where, only buying companies that are trading at 80 times earnings. Note, we have a couple of your software plays in there, which are a little bit more expensive, but you highlighted a company like Fabrinet, which is trading at below 20, PE ratio, and a Taiwan Semi, I think, is around the same. Even a Meta and Nvidia, which we'll get to in just a second, those are in the mid 20s next 12 months PE. So we're not talking about enormous valuation multiples here.
Well, yeah, and you looked at the past dominant trend, which was the growth of smartphones, which I did significant work in. There's a lot of similarities happening right now. And when Apple had re-rated to a market multiple, was actually one of the greatest buying opportunities for the stock. It took some time and some patience, but it was a tremendous opportunity. And we have a similar re-rate right now happening with NVIDIA. We'll talk about their earnings. But yeah, so I think your point is well founded about many of these companies that they have a great trend in front of them. If you can get a great trend in front of you and below market multiples, that's normally an ingredient for success.
Yeah, I think it was, 2013, 2014. I remember you talking about Apple, and not as cheap as, or it goes a little bit cheaper than NVIDIA's, but I think it was like maybe a 10 PE X cash back. And it was just ridiculous. And, in hindsight, that isn't obvious, but that's been a massive, massive winner. So do we want to move? Did you get some of your rant out? Do you have more ranting?
No, okay. I've got a rant.
Okay, that was tame. All right, let's hear it.
Yeah, that was nothing. No, I want to talk about, it is a bull market right now for the stupidest takes on the internet, and they are almost all centered on Twitter. So give me a couple minutes to break this down. We had DeepSeek. We did a very specific episode about DeepSeek. I talked about that. There are some, genuinely very hopeful advances on what you'd call kind of the algorithmic side. However, we need to create a ledger. Since DeepSeek has happened, what has been bullish versus what has been bearish? In China, where DeepSeek happened, they approved $137 billion in spending. Every single Chinese company has taken up their capital expenditure expectations. Specifically, Alibaba had a big one. There have been reports that these companies are beginning to order export compliant GPUs at their highest levels in years. Looking at the broader geopolitical environment, South Korea announced a national kind of sovereign AI project spending at least $30 billion. France announced one spending over $100 billion, and that's just a single European country. We moved to the United States. We had just had Stargate at a $500 billion figure, PR involved in that one, so caveat. And now this week, we have reports from the information that Meta is exploring a $200 billion data center. Behind all of this news, we have almost every single hyperscaler taking up expectations for this year dramatically. So, David, that's story one. We already talked about DeepSeek. Story two happens this week with reports that Microsoft is getting out of some of their capital leases. I need to talk about this situation for a minute because I've never seen, it's all the same kinds of accounts, reporters doing the exact same thing as DeepSeek. You can go back to DeepSeek. If someone's saying, look at Microsoft, this market's dead, go back to DeepSeek. They're doing the exact same area. We talked about last week how DeepSeek, there wasn't even a reaction for 4 days. It just materialized over a weekend with people doing the hottest takes possible. It seems astounding that people doing 280 character tweets onto Twitter are able to crash the entire market, but that is what we saw. And now with Microsoft, we have this repeating itself. Let me break down this Microsoft story for a moment. Microsoft has had a long partnership with OpenAI, a company with ravenous compute demands. Well, Microsoft would prefer to do the actual inferencing. The reason that inferencing's higher margin and lower risk is partially because when you're going and doing these extremely large training build-outs, you are having to take on incredible expense levels with the actual casing for these data centers, building the shell, power. You might have something like 60% of your expenses towards, securing the land, building the building, getting the power. If you are doing something that's much more inferencing centric, you can get something that maybe you're spending 70% your dollars on just compute. And compute is what you're able to bill out as a cloud computing company. So Microsoft made the intentional decision. They want OpenAI. It's a rift of some kind, but OpenAI is going with SoftBank and they are going with Oracle, and they are going to build this massive Stargate AI project. That spend that would otherwise come from Microsoft. Instead, Microsoft is pursuing a strategy around a different area. So to cancel a select number of leases that were going to take years and didn't fit into their new game plan, is more than logical. In fact, that's entirely what you'd expect them to do. And it says almost nothing about this market being fundamentally weak right now. It is totally logical. This happened months ago. It was reported by some of the largest analysts months ago. And suddenly there's a single sell side note from Cowen talking about it. And everyone freaks out. It leads to the beginning of the very large sell-off in AI stocks late last week and continuing into this week. So David, just to summarize all this, we have a couple narratives that have driven extreme selling in AI. They are both close to being BS. I'll say this. If I need to have a ledger that was good things happening in AI versus bad things, the good things right now, if it was on a weight, it is so much higher in recent weeks, yet fear has never been higher. So people will ask me, Eric, are you afraid of the sell-off right now? Well, if there was really strong narratives about AI actually kind of reaching a point where we might see some significant deceleration above consensus, I would say yes. I am more than happy to change my investing game plan. But these are some of the weakest narratives pushed by accounts with a bias for trying to get these stocks to sell off, driving the market right now. So, David, I need to do a little bit of a rant just because I find the situation, it's almost a little bit laughable. It's not that these stocks can't go down, right? There's a chance we could be wrong. There's a chance AI spending, the quote unquote bubble could burst because funding stops arriving for some of these companies, which causes, but the rush right now from the market and the need to get out ahead of everyone for a trend that should be enduring for years. I saw this in past markets, like we were talking about smartphones earlier. A lot of people were getting into the supply chain for that. Around 2013, 2014, they all wanted out. A lot of those companies have turned into generational buys. Avago ended up becoming Broadcom, and it was one of the key suppliers. Right. Smaller companies that were selling, like Cirrus Logic, selling to Apple, end up from their lows going up tenfold in years as, this kind of situation resolved itself. So I know it's hard in the short term when you have DeepSeek and you don't know what it means, and you've got people sending you victory laps from bears around Microsoft. But again, it's a time to kind of hold some composure and remember what it is you are investing for in the long term. In the long term, it is two things. It's the overall growth of AI, but specifically in 2025, it's that we are at the beginning of a new S-curve around a new scaling law that we are just at the beginning. These big training runs from the past scaling laws that were costing into the billions of dollars, we are making way for reasoning models using a new scaling law around basically running inferencing to make answers better and create new training data. We are talking tens of millions of dollars right now in terms of, spend level into an S-curve, taking that into billions of dollars. So maybe we're in a little bit of an air pocket right now while we're waiting for some of these newer Blackwell systems to continue scaling. But in terms of what I'm seeing in progress and the potential for demand the next 18 months, it has only gotten better as market sentiment has completely shifted. So I just needed to stand here, pound the table a little bit, and just say, everyone out there who's seeing all this FUD or whatever you'd call it, you just got to be able to tune it out right now, because there's every incentive in the world for people to attack this market and be fearful. But the reality is the opposite has very much played out in recent months.
I'll let you get your breath after the rant. Maybe take a sip of water. Do you think just, we've talked a lot about this kind of the eagerness of the investment community to, call the downside of, say, this is the start, this is the trigger that takes us down, this is the start of .com 2.0. Yeah. Do you think that historically, when, if you go back to the late 90s, I know you and I maybe weren't as active investors back in 1997, but do you think investors today just have so much more historical context than they ever did? I imagine in 1997, we didn't have the internet. Now there's endless ways to learn about the history of markets and these past cycles. And it feels like that's a new phenomenon that everyone is so aware of that there's this desire to be the one who sees it. And, I get it. You don't want to be caught on the wrong side of that history and be like, oh, I was the guy who thought tulips were going to go up forever. But I understand the desire, but do you think that's a new phenomenon that we haven't had? You maybe go back to it maybe wasn't as big of a deal with the smartphone cycle, but it feels so everywhere today of someone just trying to call the next big bust. Is that a new phenomenon in your eyes?
Yeah, I think you've made this point before. It's a fantastic point. There's definitely some fetishizing of like a John Paulson or Michael Burry in the housing crisis, and the track records of several of those individuals who called that are spotty at best afterwards, and I would say repeatedly failed to make investors money afterwards. I think the narrative is just so clean behind. We had the internet, we had this period of expectations, and it was a bust. That is the default perspective if you're in the market. And, one other thing, the longer you invest, you're going to realize bears always sound more seductive. It always sounds more seductive to be negative, but the market is fundamentally a wealth building machine that's returned 9% over time annually, which is incredible. And bears are wrong most of the time. That is the track record of the market. So I think if someone is saying that AI is a bubble, there's 100% certainty that they are going to be right, because we're going to have more periods like today. There's always going to be uncertainty about spending coming down. But the question is whether that advice will serve to make you money. That remains to be seen, and I believe will be wrong over the next decade. That I would rather be on the side of understanding this trend and trying to understand how to profit from it. We can all have our own unique strategy, but I think that's the right way to be approaching this. And right now it's kind of everyone out at the station. So for those brave soldiers who remain, just remember this is probably this kind of drawdown and this kind of panic. It's going to happen every 6 months to a year. That's the cost of exceptional returns over time. Go look at a chart of NVIDIA. Yeah, it changed your lives, but almost no one stuck with it. Almost no one stuck with it through the hard times. There's times that I sold NVIDIA. It was the first stock I ever bought in 2008. I sold it in part to finance a house that we were buying in 2013. I rebought into it in 2015. But it's hard. The history of Amazon was hard. If you own Netflix, you had to own it through Quickster. You had to get rich in any of these generational stocks, you had to look like a moron for a long time, right? And that's what most people don't remember.
Well, we are experts at looking like morons. So let's move on. let's give the listeners, maybe it's not direct actionable, but as we're looking at the portfolio, let's bucket some of these stocks in terms of how things have changed. Where do you see which stocks are the most risky? Which ones are the most attractive on kind of that risk reward as the landscape is just moving around? Like you said, in your eyes, positive developments. So let's just kind of reset. We don't need to go through every company in the portfolio, but where do you want to start on this?
Some of the themes. So I would say, as much as I've defended that, I believe the past few months have been continuing to be above consensus and positive for AI, but market's moving in the other direction. I will say there are mistakes that I wish I hadn't done. The first mistake I would say I wish I hadn't done, after DC capping, we put $100,000 into Meta and Amazon. I'm sure for most people, I'm creating this artificial constraint of a $500,000 portfolio. For most people, just because you bought that doesn't mean you necessarily couldn't do something in the future. But for me, that's cash that now I've got a stock that's down 10%, and I had wanted to invest in them I said I would sell down those positions over time. But now maybe we're going to go deep into an opportunity in coming weeks. And I would rather just be in cash right now. It's hard to predict the future, but there are some areas I wish I could go back and change. That's for certain. And I think you're not a good investor if you're not constantly kind of being reflective in different areas. So, if we were looking at the portfolio and you're saying we'll see where the coming weeks takes us, like I said, there's so much that can't be determined because so much of it's coming from a high level in terms of activities from the Trump administration and areas like that right now. But beginning with hyperscalers, after I just said I would have preferred being in cash, I do think right now is an excellent time to begin looking at some of these companies. One company you had asked me earlier that's not even in the portfolio, about Google. You look at every single time that Google continues dropping now, what it's doing is it's creating essentially leverage where its search business matters less and less. Because if you look at Google and you say it's worth $2 trillion, give or take, and maybe its clouds for 700 billion, and YouTube, which is going to only get more valuable with AI, in my estimation, is worth maybe 400 billion. And then it's other areas like Android and Waymo are worth maybe 200 billion. Well, if you add all those up and they're worth 1.3 trillion, Google's worth 2 trillion. That would mean its search is only worth 700 billion. So, and keep in mind that that does continue to grow. I see long-term headwinds to it, but it does continue to grow. It means it matters less and less. So again, that's not a stock in the portfolio, but it does show how these opportunities become more attractive. Amazon, on a forward basis, is trading at its cheapest levels in a long time right now. It continues to be dominant in cloud computing. Growth rates for competitors like Microsoft and Google are slipping, while Amazon held a little bit more firm. They've gotten a lot more serious about their kind of catching up in AI. So, that's a great place to look. Meta is a great place to look. I know that's dropped, but that makes it more compelling. So we've got the hyperscalers. I think Taiwan Semiconductor at these levels, it's dropped down into the 180s. It's an excellent add at this point in time, looking at the continuing dominance. So these are very high level companies. I don't want to say that they're low risk, but for exposure to major trends, I have high conviction that they will have good risk reward in the coming years if you have patience. Looking at the portfolio itself, if you're looking for exposure to larger trends, but also maybe kind of valuations that aren't too crazy, well, Vertiv has dropped dramatically. David, I don't know, you could pull up right now. But I believe that is currently oversold. That does carry more risk. If you would like less risk, but exposure to that area, Schneider Electric, it's not going to move nearly as much because it's a little bit more diversified and the story's built into some growth areas, less like liquid computing. And you mentioned earlier, I continue to believe that optics are a tremendous story in the years to come. Fabrinet is a company that I've heard them described as the Taiwan Semiconductor of the optics industry because of their expertise in designing all across the optics value chain. I think that's a great description of the company, as you noted. They're trading for something a little above 20 times. They've got a big cash hoard. They're playing well into trends. Their production is in I believe it's Thailand. So, you don't have the exposure of like a Taiwan being invaded. You don't have all your production in China with geopolitical fears. So in terms of the picks and shovel plays, I really like that opportunity. Now, we're gonna talk about some of our software plays later. Last week, I gave a research as it happens on Unity as a low price to sales stock. It immediately jumped 30% after earnings. It is now losing some of those gains just with the general market sell-off. Spoiler alert, we might come back to that later. But it is now trading, I think, for 4 to 5 times sales. And while its valuation is a little higher, I believe at still 11 times this year's forward sales, when we had looked at GitLab as a company with trends facing it this year, it's very much within the software average and also continues to get cheaper as we see the sell-off. So David, it's just what we've talked about is, again, mistakes that I wish I could maybe go back. I mentioned why the hyperscalers thing. I probably, if I could, I wish I could have had that in cash. Hindsight's 2020. One area that I struggle with is I think that the data center opportunities look very good right now, but I also just want to be aware that they are going to be very risky and leveraged specifically to kind of every low supply chain bump. And, that can be scary for people who invest in them. So that's why, today I was kind of giving, once again, something like a Fabrinet that has a lower risk profile and again, might continue to be attractive as the sell-off happens. And then we're also moving into the software plays. The downside of the software plays, as I mentioned, Cloudflare, extremely expensive. If you have a big risk off, that's just a stock that's probably going to take you on the chin. But there are some stocks trading at more kind of cheaper valuations as we continue trying to build out kind of the software sleeve of our portfolio. So David, you can follow up with anything right there, but hopefully that gives kind of people an overview that if they are looking at this moment, what are the opportunities? What's something where maybe I'm not getting onto the bleeding edge of risk? If you're looking at the bleeding edge of risk, like a credo, that is bleeding edge of risk. After DeepSeek happened, we tried just doing a tiny, I think it was only 2,500 addition to that, just that, a post DeepSeek rebound. We've obviously seen the opposite of that, and that's going to continue selling off hard. As long as we're in a risk-off environment, Credo will get hammered. There's no question about that. So knowing which stocks right now will sell off the hardest in a risk-off environment is important if, you need to watch your own temperament. You want to kind of minimize the potential drawdown you could have.
Yeah, and I hear you on your mea culpa on using the hyperscalers as your cash equivalent of Meta and Amazon. But, I'll give you a little bit of an out. I do think, the market can prove us wrong and we can be very wrong. I think what, as you mentioned, kind of breaking Google down in parts, in previous episodes, we did similar with Amazon, looking at, their advertising business, the retail business, the cloud business. Everyone's looking at these as pure just, the growth of AI and increased use of cloud services. If there's any companies that are going to benefit from the implementation of AI into their own business, these companies are front and center of Google's advertising business getting better because of AI. We've already talked about Meta implementing AI in serving their ads and moving to GPUs and the huge boon that was. Amazon, again, if there's any company that's going to embrace this technology for efficiency, cost reduction, growth, it's going to be these companies. So I'm with you. I continue to be bullish on those companies, despite I understand that they're huge and people might look at those and say, come on, we're talking 1 trillion, 2 trillion. How much bigger can these companies get? These companies are fantastic. And we've talked about the price. It's not outrageous for, the growth of the AI business. But then again, I really come back to that implementation of AI seems like it's a slower story. It's not going to be the, oh, wow, we made this one change and here it is. But it feels like over the next 2 years, you could see some really big impacts to the other parts of their business of them implementing AI is my point of view on these.
Yeah. And I don't want to belabor this too long, but one kind of short story, because you had mentioned Amazon and people might be wondering practically, what does it look like for companies to start taking advantage of a lot of these breakthroughs? In the past, I'll try and code this as much as possible. I knew of a business that had a relationship with Amazon that Alexa was paying them for access to their data. And they essentially had engineers in all these small subsectors, things as small as making sure that animal facts of the day were correct and trying to handle all of the edge cases. And this was a time when I believe they had gone over 10,000 developers attached to their Alexa initiative. I heard that and saw that and said, oh, there's no way they're winning here, because we were already starting to see Tesla taking self-driving and getting rid of all their, C code and saying, nope, it's end-to-end neural nets, and seeing this vertical takeoff. And just this past week, we saw Amazon basically bring Alexa into the future. And if I had to have a guess, what happened is they removed all of that, old edge cases that required 10,000 developers, and now it's edge-to-edge neural nets. So, it's spending that previously would have been going to 10,000 developer jobs. And now that spending's kind of going towards GPUs. And there is, a downside to that of, you wish you had jobs for people, but the other side is it starts creating that kind of curve of progress where Alexa felt deeply unusable for a long time and now feels usable. And what we saw this week as well, on that note, a lot of robotics firms, if you're like, why am I starting to see stuff about robotics? I'm like, well, robotics is going to end-to-end neural nets. And the companies at the forefront of it are all saying that they are seeing leaps in progress beyond anything in their wildest dreams. And that's why robotics is going to be an area we'll talk about more in the podcast throughout the year. It's going to get very interesting very fast.
All right, let's move on to some news. We obviously had NVIDIA earnings.
Yep.
I don't know how much time you want to spend on this. We saw the initial reaction was negative. I'm sure if we actually look at the results, it's not bad. It's probably one of the best quarters in corporate history. So let's just maybe just give your quick take on where do we stand with NVIDIA in terms of, future growth, valuation today. It's obviously in the portfolio. So just what was your take coming off of the earnings?
Yeah, I had a few people text me after it happened. They're like, is this the greatest quarter in earnings history, and the next day, intraday, they're down 11%, which, the positive thing I'd say, we don't need to spend more than a couple minutes on Nvidia, and that's kind of great. It's good to move into more of a boring era. Even when we first started this podcast, Nvidia earnings might be an entire episode, but, Nvidia largely delivered. They beat EPS. I think it was 89 cents versus expectations of 84 cents. The next quarter, they beat by 2%, which is maybe a little light, but kind of in line with where they are at this size, and their gross margins were a little bit lower. There's nothing that it's kind of like a good to great quarter, but not exceptional. And I expected them to be relatively flat, maybe down a couple percent. They were down 8%. That was all just broader. That was just all broader macro driven. Like, it wasn't really anything that Nvidia did. Now, I will say the one thing, if you're focusing on Nvidia's earnings, that matters and will continue to matter in the future, is when Nvidia started building is their kind of sales pitch into the future. They started moving beyond, you saw Jensen Huang getting a lot of attention, talking about Reasoning taking 100 times compute that prior models were taking from just, mostly pre-training. Mm-hmm. And he also started paying a picture up to 100,000 times or more compute. So, that's a little bit countering the DeepSeek narratives, and it's leaning into why I've talked about earlier that we are on this new S curve, but people, I don't think, fundamentally are seeing and understanding what's going on with that. Now, the other thing that they're doing is talking about the next narratives that are going to drive sales for them, which they have as enterprise adoption of agentic AI. We've talked about that plenty in the show. And basically, AI into the physical world. One area, it's fine, Mike. No one talks about it because NVIDIA is so big, but their self-driving business is absolutely on fire. It's beating expectations by 30% quarter. It's growing at insane rates. They're starting to get multi-billion-dollar wins with some companies like BYD. As I alluded to earlier, what's happening in self-driving cars is going to flow through to a lot of other physical world spaces. So why this all matters is NVIDIA is hosting an event named GTC. They're going to be able to announce future product lineups at that, which will matter. But the more important thing to watch is the narrative that they're building beyond just this kind of data center frenzy. Because if you're NVIDIA, I'm sure it's a difficult thing to look at right now, that your number one weakness is your exposure to this concentrated hyperscaler spend. And they want to start building out a narrative that there are spend lines that are getting ready to take off well beyond that. And if they can win that narrative, it's going to set the stage for how NVIDIA is going to be able to, even at its current size, handily outperform the market in years to come. So I think that's not something anyone's talked about, but it's what I'm watching. And when GTC happens, that's what we'll be following up on, future podcasts.
All right, let's move on to Snowflake, another company in the portfolio. This is one of the more, software-driven companies, trading at the higher multiples. Reported earnings, really positive initial reaction. The stock was up over 10%, but then settled down a little bit. How are you feeling after getting? I feel like getting these insights from the software companies is just a little more interesting because, again, the infrastructure stuff just takes a little bit of time. It's a little bit more, like you said, NVIDIA. We kind of knew what to expect. There wasn't going to be massive surprises. A little more interesting hearing from the Snowflakes of the world. So, what caught your attention?
Yeah, and again, we don't need to spend too much time on this, but I wanted to highlight it because they were up 14% early trading, down to 4%. So, you had a very positive reaction that, you're not having to pay for in the stock at this point. But what they brought up, I recommend Snowflake to the portfolio as one of the earlier software companies. I think as agentic AI takes off data platforms and basically these agents from companies needing to interact them becomes significantly more important. And Snowflake has been extremely aggressive about building out kind of the AI services on top of its core offerings. And they forecast a pretty good sized takeoff and beginning of some extreme momentum in the second half of this year, which is kind of the timeline I'm watching for some real revenue to flow through. And I want to get positioned for these companies before then. So if we've been saying, watch on the second half of the year for some of, these enterprise companies, we want to be positioned in front of them for them to start seeing real revenue that begins that process of maybe seeing revenue go up from a 25 to a 30 to into the mid 30s level. And if that happens, we expect to see very significant returns on these companies. The company basically boasted confidence that's going to happen. So, we try and outline the idea we're talking about, and we pick stocks. It's some compelling evidence that the idea has some pretty strong merit to it.
Yeah, Snowflake obviously have such a great portfolio of enterprise customers. Salesforce, not Salesforce the company, their Salesforce out there talking to these companies. And, if you're imagining the C-suite of many of these large companies, it's the CTO in there and the CEO asking, what are we doing with agents? And are we using agents yet? And Snowflake obviously in a great position to enable services that allows that CTO to say, yes, we are using agents now.
Well, and that's Palantir. Again, it's we because by the time we launched the portfolio, Palantir had shot up, but we did put Palantir. We were doing videos early last year about why it had such extreme potential. We put in our main report that we had built in the spring of last year about the next NVIDIA, and it, that's what kept being in my mind is you've got every CEO in America saying, what's our LLM strategy? How are we going to do this? It's the number one, go-to source, and they just need to kind of get their sales path right. And once they did that, they could start seeing that path from 20 to 35% growth. And that's exactly what's played out. And I mean, they're up 500 or 600% from the lowest levels. I don't expect that with other stocks. There is kind of a little bit of a mania happening, and that has burned off in recent weeks a little bit, but it just does show the path that you can follow if you get this right.
So the other company that reported was, you mentioned them earlier, Unity, company that you kind of pitched as a one to watch, potential research stock. How are you feeling after earnings? Is it ready to come into the portfolio? I know, how are you thinking about this company now?
Yeah, the earnings were terrible.
That doesn't matter.
But they're up 30%. No, just because they did exactly what we said they would do. They began getting serious about their ad tech program and building around that. And AppLovin, the company that we said, they needed to kind of model themselves after, that's been in a short seller war. But the short seller war around that's mostly that they're pushing into e-commerce areas right now, and people are saying it's low quality. Where they actually saw the bleeding edge of growth in their business was basically having, a unique data from video games and being able to build a better ad tech network. So I think that's going to play out again with Unity. So in terms of bias today, in terms of what I want to add, this is going to be a continuing theme, but I want to make sure that we have software in addition to all of the kinds of companies that are in an advantaged position in this kind of data center chain. I think a lot of those companies are at great prices today, but we have exposure to them. So this is where I want to continue just diversifying across ideas and software. So I just wanted to do another 5,000 addition to Snowflake, and then start just a $5,000 position just to get in, because I gave the sales pitch last week. I wish I would have done this last week. That's a mistake. But Unity after that report, I believe it was up past $28 a share. As I was looking at today, it's back to 25. So you've kind of had half of that kind of earnings gap kind of come back down. And again, this is a company that when you're in a sea of software names trading for more than 10 times sales, it's relatively cheap. And the pathway has been illustrated of what they need to do. And now they just need to start operating at, I wouldn't even say an exceptional level. It's just a kind of relatively competent level. And I believe with some of the actions that we've seen recently and some of the emphasis that's going to play out. And, I think there's more upside than downside in the name. So we'll get that one added. It gives us an ad tech play to be able to add to some of the platforms and other enterprise areas that we're doing. So we just continue diversifying kind of our software exposure across the portfolio.
All right. That sounds great. Ending on a positive note, adding Unity, adding a little bit more to Snowflake. That sounds great. Just again, to all the listeners, hang in there. We know it's been a little bit of a rocky few weeks, but it happens. We're right there with you. We're going to keep doing the show. We're going to keep managing the portfolio. Eric, anything else before we sign off and you enjoy your time in Argentina?
I hope everyone has a nice, relaxing weekend. I know, as you mentioned, the markets right now, it's not fun. It's not fun looking at your portfolio every day. It sure feels negative. It can create a lot of self-doubt about what you're doing. But again, if you go back, you kind of analyze that, if you want to call it first principles or the overall idea or whatever you want to call it, I don't believe that the core thesis has shifted, and I do believe that showing some patience and resolve through these periods will be rewarded in the long run.
Sounds great. All right, we'll see everyone in 2 weeks. People on the show may have interest in the stocks they talk about. This is not investment advice, so don't buy or sell based solely on what you hear.